Right now, the ticker SMCI, Supermicro Computer Inc., is printing at exactly 33.21 USD, inching upward by 0.29 points, or roughly 0.87% in today's intraday session. If you are watching this stock on your Fidelity mobile app or tracking the order flow on an Interactive Brokers trading platform, the price action might seem deceptively lethargic. You are seeing a stock that was once the darling of the AI revolution, a company that briefly traded with the volatility and fervor of a crypto asset, now languishing in the low 30s. The expectation, the prevailing narrative you will read in the headlines and on social media feeds, is that the super micro trade is effectively dead. Investors believe that the competitive noose has tightened, that titans like Dell and Hewlett-Packard Enterprise have successfully commoditized the server rack market, and that Supermicro's era of hypergrowth has evaporated into a cloud of shrinking margins and regulatory headaches. The market looks at that 33.21 USD price tag and sees a value trap, a company that missed its window to become a permanent giant. But the reality, the hidden mechanic that is driving the smart money to quietly accumulate shares at this precise level is completely different. We are not watching the death of a company, we are watching the messy, expensive, and absolutely necessary transition from a hardware assembler to a thermal utility for the next generation of computing. The disconnect between the failed growth stock narrative and the critical liquid cooling infrastructure reality is the arbitrage opportunity of the year. To understand why this 0.87% move is significant, we have to look at the context of the last few weeks. The stock has been battered, dropping significantly in November due to fears over margin compression. But at 33.21 USD, we are seeing a distinct change in character. The selling pressure is drawing up. The volume profiles on the daily chart show that the weak hands, the retail traders who chased the momentum on the way up, have largely capitulated. What remains is the accumulation volume. This is where institutional players, the kinds of funds that manage Fidelity investments or massive pension allocations, step in to buy the blood. They are not buying based on last quarter's earnings, they are buying based on the physics of the future. They know that the next wave of AI chips, specifically Nvidia's Blackwell and the future Rubin architecture, physically cannot be cooled by air. You cannot blow a fan on a 1,000-watt GPU and expect it to survive. It needs liquid. And Supermicro Computer, despite all the noise, remains the undisputed leader in shipping direct liquid cooling solutions at scale. The market is pricing SMCI as a box mover. The reality is that they are a plumbing company for the internet's heat problem. Let's dive deeper into the margin compression that has terrified Wall Street. The expectation was that as AI demand exploded, Supermicro would have infinite pricing power and fat margins. The reality, revealed in their recent fiscal reports, is that gross margins have compressed, hovering around that 10 to 12% range and sometimes dipping into single digits depending on the product mix. The bears see this and scream, "Competition." They assume Dell is undercutting them. And to an extent that is true. But there is a strategic layer here that the algorithms miss. Supermicro is purposely sacrificing margin today to capture socket share in the new liquid-cooled data centers. When you build a data center designed for liquid cooling, you are laying down pipes, manifolds, and coolant distribution units, CDUs. Once a customer installs Supermicro's plumbing, ripping it out to switch to Dell is incredibly expensive and operationally risky. By taking a hit on margins now to get their hardware into the AI factories of Tier 2 and Tier 3 cloud providers, SMCI is building a moat that is physical, not digital. They are locking customers into their thermal ecosystem. The 33.21 USD price tag reflects the pain of the investment phase, not the payoff of the retention phase. I want to pause here and ask you a question about your own tech setup. Comment below if you think liquid cooling will ever make it to consumer desktops or if it will stay locked in the data center. The heat output of modern chips is getting insane, and I'm curious if you'd ever put water inside your own PC. Looking at the recent financials, specifically the first quarter fiscal 2026 results, we see a mixed bag that explains the current consolidation. The company posted revenues of $5.02 billion. While that is a massive number in isolation, it technically missed the consensus estimates and represented a decline by about 15% year over year. This revenue miss is what triggered the initial sell-off that brought us down to these levels. But look at the earnings per share. They posted 35 cents, which actually beat some of the lowered expectations. This divergence, missing the top line but managing the bottom line better than feared, suggests that management is getting tighter on costs. They are navigating a digestion period in the AI market. The hyperscalers, Google, Microsoft, Amazon, spent billions in 2024. Now, in late 2025, they are optimizing. They are waiting for the Blackwell chips to arrive in volume. This creates an air pocket in demand. The stock price at 33.21 USD is essentially pricing in this air pocket as a permanent decline. But if you believe, as Nvidia does, that the demand for compute is only beginning, then this air pocket is the perfect time to enter. The reality is that the backlog for liquid-cooled racks is growing, even if the revenue recognition is lumpy. We must also address the accounting shadow. Late last year, the company faced a storm of allegations regarding accounting irregularities, sparked by a short seller report. This crushed the stock and destroyed investor trust. However, the subsequent investigation by an independent special committee largely cleared the company of the fraud label, although it did highlight the need for better internal controls. The market has a long memory for trauma, but a short memory for details. Many investors still have a "do not touch" flag on SMCI because of those headlines. This is the expectation lag. They expect a smoking gun that never appeared. The reality is that the company is moving forward, having strengthened its governance, and is now trading at a discount due to a reputational tax that is slowly expiring. For the objective investor using a self-investing strategy or a Schwab Intelligent Portfolio, this discount is a gift. You are buying a cleared asset at a distressed price. Let's talk about the technology itself, the building block solutions. This is Supermicro's core philosophy. Unlike competitors who sell rigid, pre-configured boxes, SMCI sells Lego blocks. You can swap out the motherboard, the power supply, or the cooling loop without replacing the whole chassis. In a world where chip technology is advancing every 6 months, this modularity is crucial. It allows data center operators to upgrade their GPUs without throwing away the steel and copper infrastructure. The market currently favors the integrated stack approach of a company like Dell, which offers a one-throat-to-choke service model. That is the safe corporate expectation. But the reality of the AI startup world, the XAIs, the CoreWeaves, the Lambda Labs, is that they need speed and flexibility. They don't want a 6-month lead time for a standard Dell box, they want a custom Supermicro rig they can deploy next week. SMCI's ability to customize at scale is their speed moat. While the stock sits at 33.21 USD, their factories in San Jose, Taiwan, and Malaysia are churning out custom configurations that no other Tier 1 vendor can match in terms of time to market. Institutional ownership is another key indicator we need to dissect. If you look at the 13F filings and the flows into Fidelity mutual funds or ETFs, you see a rotation. The momentum funds, the ones that buy high to sell higher, have left. They exited when the stock broke its trendline months ago. Who is replacing them? The value funds and the indexers. Vanguard Group, for instance, has been increasing its position. BlackRock is steady. This shift from hot money to sticky money stabilizes the price. It reduces the volatility. When you see a stock trading up 0.87% on a quiet Wednesday, it means the shareholder base is no longer looking for a quick flip. They are looking for the FY 2026 revenue target of $33 billion to $36 billion. Think about that number. The company is trading at a market cap of around $20 billion, yet they are targeting $33 billion in sales. That is a price-to-sales ratio of less than 1. For a tech hardware company in the hottest sector on Earth, that is absurdly cheap. Nvidia trades at 20x sales. Even Dell trades at a higher multiple of its AI revenue. The market is pricing SMCI like a dying retailer, not a growing infrastructure provider. The energy angle is the next major catalyst. The world is running out of power for data centers. We can't build power plants fast enough. The only way to add more compute is to make the data centers more efficient. Liquid cooling reduces the power consumption of a data center by up to 40% because you don't need massive air conditioners, chillers, running 24/7. You just need a pump. Supermicro's green computing thesis, which they have been preaching for 20 years, is finally aligning with the economic reality of the grid. The expectation is that power constraints will kill the AI boom. The reality is that power constraints will actually force the adoption of Supermicro's technology. They are the hedge against the energy crisis. Every time a city council denies a permit for a new data center due to power usage, it is a bullish signal for SMCI, because the only way to get approved is to show a lower PUE, which Supermicro delivers.